All right, guys, welcome back to We Talk Money, Bear Market Revenge Trading Edition. I want to start by talking about revenge trading because I've seen a lot of it happening in the markets and what it means, why it's so dangerous, and why it can kill a trader or investor, their long-term prospects, right? So what is it? What does it mean to you guys? What's revenge trading?
Revenge trading is when you get upset because of either prior trades that went wrong or investments that went wrong or boring market environments, and you're trying to get money back. Like a lot of people are in drawdowns right now and they're down in their portfolios. So they're like looking at their position and they're like, oh my God, I need to make money. So they just start using leverage and doing reckless shit and get themselves in trouble because they're trying to make back money or whatever the case may be.
What about you, Trav? Anything to add?
That definition basically nails it. But yeah. I think if we saw a lot of YOLOs during the bull market, I think we also see a lot of YOLOs during the bear markets when people are like, well, I'm down 80%. With my last 20, I'm gonna try to make it all back.
Yeah.
It's a spiral, right? It's like, here's how it works. Step one, you lose money, right? This could be a day trader. This could be a long-term investor, whatever, right? It's like you have a losing trade or a drawdown in your portfolio. Step two, you get aggressive and you start trading more, Nikki, like you said, to make that back. But if they're bad trades or low probability trades, you end up drawing down more. And it's like this downward spiral. The worse you do, the more aggressive you get. And it's like a self-perpetuating cycle that, Jared Tendler talks about in The Mental Game of Trading, and a lot of other psychology books that we've mentioned on the show also allude to it. But why it's so dangerous is because when you should be doing little or nothing, if you start really pressing the gas, again, it just kind of like compounds the pain.
Mm-hmm. One of the things that I see a lot of investors do, even in the professional ranks of investing, is a flavor of this where they actually shift into a different strategy or a different asset class, trying to, basically capitalize on whatever's hot at the moment. And so you end up like chasing, perpetually chasing things. And we're actually seeing a lot of that even in the professional ranks right now, where investors are starting to, become tourists in macro. Like equity focused investors are starting to spend too much time trying to figure out the macro picture and not focused on researching companies. They're even diving into different sectors, like things like energy that maybe they're not, experts in. And so we see a lot of that happen during some of these cycles, and it can actually forever hurt the reputations and track records of even great investors.
Yeah. So what do you do? I think there's like three periods of time in markets, right? There's a time to push like hell and take every opportunity that you get. There's a time to slam on the brakes and really just chill and do nothing. And then there's kind of those transition times, right? Where you want to not become disengaged with the markets, but you want to stay engaged, see what's happening, and prepare for the next opportunities. I think that's where we are, right? Is maybe not in a, just pack it up and leave moment, but it's in one of these moments where it's like, hey, the crypto prices are already 70, 80, 90% off of all-time highs. This is where we get a lot of that emotional rage quitting, people, revenge trading, over-leveraged trading, and just really capitulating, just going on Twitter or Discord channels and professing their quitting, right? We see this every bear market. And I wanted to address it because if anybody's listening to this that's like, oh my God, I can't believe we're here. It's like, just go back and look at market cycles, right? Like this is a part of the way that crypto behavior works and also the stock market works. It should not be a surprise to anybody. And if it is, it's probably because you're new. And welcome to the show. We're going to help you understand these market cycles.
Welcome to Trading and Investing.
Yeah.
101 or 201. Yeah.
Yeah. So I don't know. We can dive into the charts. I definitely want to talk about where crypto is and really the only narrative that actually matters right now. And also the ETH merge. We've got a bunch of questions on the personal finance side. We've got market sentiment indicators that we can look at. We've got some housing data that's kind of interesting. But yeah. Anything else on revenge trading before we jump into that?
Well, I guess typically that happens to the newer traders, right? Because the more experienced ones have done enough revenge trading in their day to know not to revenge trade, but even they slip up.
Yeah.
Right. I think that more experienced investors, instead of doing revenge trading, something they might do is not manage trades accordingly as they normally would.
Yeah.
Like maybe they move their stop losses up sooner than they normally would. Like there's still that, like, the market has instilled a little bit of fear in us over the past year to date, whatever. And so people are a bit more timid. Even professional investors are like, what are we doing, and trying to figure this out, right? So I think that sometimes it just I lost my train of thought.
Well, I'll say this because what you're saying sparked something I'm thinking about,
Okay.
which is that the turn will probably come quick. I don't know when it's going to be. I don't know if it's going to be in a month or 18 months, but it'll come quick, and it'll come at a time when people are not expecting it. And most professional investors and retail investors for sure will not be positioned correctly. That's why I think
Right.
a lot of people were saying that maybe the markets did bottom in June. When I think it was S&P, 3,600 or something. I wasn't convinced that was the ultimate bottom in this cycle yet. We'll see. But a lot of people were saying that could have been the bottom because people are not positioned. A lot of the investor portfolios, even at the professional level, net exposure is very low. Funds took down their exposure. They're positioned very bearishly. And so that does tend to happen when we bottom. March 2009, April 2020, those are the times when we actually do get a bottom, and most people will not be ready for it, and they will when we come out of the bottom, they will still be in the mode of the market's wrong, the macro's still bad, but one thing you have to remember is that it can happen fast, and the market is very forward looking.
Yeah.
So,
Yeah. I think the key is just being dynamic, like with the whole revenge trading thing. And like if you're managing positions differently than you normally would, I think it's just a matter of always being nimble and dynamic to align with your market environment. And that is that's much easier said than done for a lot of people, I think.
The way that I think about it too is like when we're in a bear market, I'll probe long opportunities. Like I'll take trades to stay engaged, but I'll cut them off quickly if they don't
Right,
work.
exactly.
And the sizes are much, much smaller than bull markets, right? So
Yeah.
it's kind of like I stay engaged and I have lower expectations that things are going to work out. And then I'll hedge with shorts. I guess one regret that I have with this market cycle is I haven't shorted as hard and as heavy as I had in prior market cycles.
Welcome to the club, buddy.
Yeah, which is that's easy to look at in hindsight, right? I probably could have done it, but it's fine. I hedged, I sold a shit ton at the top. I take a few probe opportunities here and there. I'll take a few strikes, right? I'll take a couple of stabs at longs, and then if they fade, and I'm like, no, bulls aren't here. Cut it off quickly.
Right.
Don't be stubborn, right?
But you never know when we don't know when the bulls are going to come back. Like, so it's okay to take those probe trades. I know I did a few as well. I mean,
Yeah.
I had some that, took a few options trades that just, died out and nothing happened. But I wanted to position just in case because there was a possibility that the market could have turned. And I think that's fine to do, but you just have to manage, like you said, with the right size, with the right quickness on cutting the trade. And that you have to just stay disciplined.
I think, so we have two trades on right now that are kind of special situations that can be not correlated to the broad market, like Blue Apron on your end, and then a special situations with Lionsgate on my end, which we can talk about, trade idea. But the other thing is having your shopping list ready and like doing the homework in the bear market and being ready to, when the market does bottom or when the macro picture starts to shift a little bit, you're ready with the stuff that you want to own and you don't let it run away from you too quick. There's always going to be stuff that'll run away too fast, but there's also times when you need to prep and do the work so that you can have a view when things start to turn.
And to me, let's talk about the big narrative in crypto right now. And really the only thing that I think matters and how it's relevant to revenge trading and what I'm seeing in market sentiment kind of across the board. I actually tweeted this just a little bit ago. I took a snapshot of my laptop here in the studio and I said, the only chart narrative that matters right now And this is it. Everything else is noise. And that is that the NASDAQ is driving market direction for not just stocks, but for crypto as well. And I've been talking about this since the peak, after the stock market started selling off and crypto was following very closely behind. It's been crystal clear that this is really the only thing that matters. Bitcoin is in a confirmed bear market, obviously. And whenever we broke below the 100-period moving average on the NASDAQ last week, we've just seen nothing but systematic kind of regular volume selling in Bitcoin. And so when you look at the chart, there is nothing confirming a bottom. There's nothing really even hinting that this is the bottom. Right now, we're testing multi-month support, and we're basically squeezing, and there is really about 50% downside potential from here. So a lot of people that have been trying to call the bottom, there's really no strong sign that we've had either a massive washout or an accumulation range that's actually holding up, right? Again, watch the NASDAQ, and the NASDAQ is telling the story. And because the volume's actually been increasing during this sell-off on the NASDAQ, crypto has absolutely followed. And one thing to keep in mind is Bitcoin goes down a lot further when stocks sell off percentage-wise, but in bull markets, it can also go up a lot further, right? It's just more volatile on average.
I think that, I'm going back to my original call, which was that we're going to see choppiness. And I think that the NASDAQ right now, it's in a choppy zone. Like it's there's really no rhyme or reason, of how it's moving right now. It's mid-range and choppy. And so Bitcoin's going to do that probably for a while. And maybe the bottom is, and we got this as a question, is the bottom in or not? And we've talked about this a lot. And I would say that the market is putting up a damn good fight. It's trying.
You're talking about stocks. I think we need to differentiate between stocks and Bitcoin, because the NASDAQ, when you look at, the last 6 months, it's in a mid-range, but it's challenging multi-month support, and it's by far or far from bullish, right?
And now I'm starting to wonder, could the tables turn, and if Bitcoin ends up crashing through support, could that end up moving sentiment in the NASDAQ? Because we know they're moving together, right? Or for the most part. And so now I'm wondering, could the tables turn, because Bitcoin does look weaker?
Yeah. I don't think Bitcoin's going to lead stocks lower. I think, if anything, the NASDAQ's been leading Bitcoin. But Bitcoin could certainly break down without taking stocks with it. I mean, I'm looking at this squeezed into support right now, and look, it could absolutely V-bottom and capitulate at any moment, but we have not had a high-volume capitulation washout, and we haven't had a regular, long-term accumulation range that's kind of confirmed support's holding, right? If we bounce off of 18K here today, that could be evidence that we're going into accumulation. But with stocks heavy and Bitcoin just really showing no buyers at all, I just don't see this being the bottom.
Okay. I mean, I think that that's interesting to hear you say that, and people will find that interesting. So basically, the next major support level is what, 10K?
Yeah, around. There's a few fib extensions. The major area is around 10K. Yeah.
We've got some, couple of big events this month in stocks too that will largely dictate probably what happens, which is the CPI report next week in the U.S. And, I actually think that could be maybe a positive catalyst in the short run, in the very short run for markets, just because I think we'll see a little bit more deceleration in the rate of inflation in the U.S. Unfortunately, Europe's going the other way, so that's the flip of that. The second big event, of course, is the Fed meeting in mid-September, actually mid to late-ish September. And that will be an event that, who knows, but again, the market's kind of pricing in right now 65-70% chance of another very aggressive 75 basis point cut.
Cut
or hike?
Hike, I'm sorry. Thank you. Hike. But if we only get 50, then that's something I'm starting to think about is if this market continues to sell off and then, the Fed only raises 50, then that's going to be very interesting from a trading perspective, at least short term. I'm not saying that's going to happen, but I think it's worth thinking about because most market participants are kind of baking in 75.
I thought 50 was what they were baking in. Did the tables turn on
Yeah,
that?
it's a 70% probability now of 75 after Powell's
After his speech?
After the speech at Jackson Hole. But there's things that are happening in the interim, which include like the European energy crisis, high rates of inflation in Europe, the dollar being very strong against things like the yen just hit a new multi-decade low against the dollar. And you've also got real estate kind of looking very weak, which we can talk about.
Let's pull this up. Actually, I think it's a good point to take a look at this chart. It says, what direction have home prices moved in the last month? And we can see in the earlier part of this year and late 2021, anywhere from 75 to call it 90% of prices were increasing, with only 1 to 3% of prices decreasing, right? So basically almost all prices were going up or flat. Right now it's a third, over a third are actually decreasing. About half, 45%-ish, are mostly flat, and only 20% are increasing. So the tides are absolutely turning here.
This is what the Fed can control, though, right? The housing market is what the Fed can control the most.
I mean, this is absolutely a knee-jerk reaction to rates shooting up, right?
Absolutely.
It directly affects affordability.
Yep.
Totally.
And we're at 6+ now because rates have moved up in recent weeks. So if you look even at short-term rates after Powell's speech, the 2-year, the 5-year treasuries are up at 3.5. Hitting multi-year highs again. I'm going to check in on this and make sure, but yeah, I think we're actually at 3.5 now on the 2-year.
Yeah, there was a big breakout yesterday on the 30-year. It's 3.5.
I mean, that's a more than a 5-year high. So in fact, I think you have to go back to like 2007 or 2008 to find rates on the front end of the curve that are that high.
Yeah.
So that's pushing up mortgage rates, certainly. I mean, even looking out on the 10-year and the 30-year, which are probably actually arguably more relevant for mortgage rates, those are also hitting multi-year highs. So yeah, I mean, that is directly affecting the housing market, directly affecting any activity related to housing, and the metrics continue to worsen there in real estate. So
I think that's a good thing.
Yeah.
I think
Yeah.
we absolutely needed a slap in the face. Prices were stupid. In Austin, people were, what was it? It was like a couple thousand transactions sold for 6 figures over their listing price. That's not sustainable.
Yeah.
Even in a place like Austin where everybody wants to follow Joe Rogan there now.
Now, it's like a seesaw, though, right? Because rates are moving higher. So even if prices cool down or go flat or whatever, I mean, the buyer still has that interest rate to deal with, which is definitely affecting the affordability of the mortgage. So I don't know. It's like the consumer either way in the real estate market is kind of not in a great spot. It doesn't feel that way, maybe in certain areas of the country, but it still feels tough out there for first-time home buyers or people looking for a home with this rate situation. But the good news is that the deflation word is starting to get thrown around a lot more, and a lot of macro peeps are coming out talking about the D word, which is kind of a first. I haven't really heard much of it at all for a long time now. And that, if Jay Powell puts us in a recession like he said he would if he has to, I mean, what happens, right? The Fed starts decreasing rates. So the refinance market maybe in the future will be, something that the consumer can look forward to if they are buying a home right now with rates where they are.
Yeah.
It's just something to think about.
I mean, commodity prices are very weak right now. Crude prices, $85 a barrel, down, still up on the year, but, down significantly in recent weeks. I think copper's down over 20% year to date. Silver and gold, very, very weak.
Gasoline futures are down 45% from the all-time high. It looked like we were going to have a breakout in May, and then strong reversal. So that's actually really good for the consumer. Gas went from, mid 4s down to mid 2s.
Yeah.
That's a huge deal.
And that will flow through near term in the CPI numbers, which is why I think the September and October CPI numbers could, surprise to the lower side finally.
Yeah.
And again, I don't know how the market kind of knows that, but maybe that's a positive potential catalyst for the market after a couple of weeks of deep selling. The X factor still out there. I think that's still got market participants worried is what's happening with energy in Europe, and the concern Nord Stream pipeline got cut off again. The flows there, so that's a concern. Of course, the concern over like what happens with bills in the winter. The UK is trying to like cap prices, but that just shifts the burden from consumers to the government balance sheet. So now we've been seeing some of the European debt, some of the European yields spike. So Germany, UK now seeing their yields on government debt spike up, and that's that's
so
kind
the
of
bonds are dumping. Basically.
Yeah, bonds are dumping.
People are selling the bonds
in Europe. And there's also some worries now about banks in Europe having to deal with margin calls on some of these energy hedges and things like that. So
that would be kind of a interesting wild card because everybody's like moved into commodities heavily. Some people, and people forget that commodities are extraordinarily volatile.
The cure for high prices in commodities is high prices.
Right. Yeah.
Higher prices, decreased demand. And it's not like stonks or crypto that can just go up for long periods of time. Like there's going to be sell pressure there.
I think people forget that commodities are more volatile than growth stocks, and that's just something to keep in mind for anybody that is heavily into these commodities now.
I wanted to ask you guys about the Buffett Indicator. This is something that I've seen floating around on social media a lot. For anybody that doesn't know, the Buffett Indicator is what, Travis? How do you describe this?
I think it's been defined as the total market capitalization of U.S. stocks divided by U.S. GDP. Typically, some people might use a global indicator with that, like global market cap divided by global GDP, but Buffett, I think, used the U.S. version of that.
Yeah, so I'm pulling up this chart here that was going around Twitter, and basically, I guess what you're looking at is like the total value of the stock market compared to like the productivity of the U.S., right? Yeah. So you look at like the cost of stocks compared to the production of the economy, and right now, when you look at this chart, late 2021, it was at a massive level above the dot-com bubble of 2000, but we are still above the dot-com bubble on this metric, right? And so I think a lot of people are looking at this and going, holy shit, there's a ton of downside here for stocks. Do you guys think that's the case, or is there something else to kind of think about here?
So there's two big flaws with that metric. I do think it can be useful at extremes. So when we see that chart get to extreme high levels, like we saw at the end of 2021 or early 2021 rather, and then, the lows that we saw in like early 2009, those extremes would suggest, early 2009, the market cap of public stocks pretty undervalued relative to the overall economic activity, and then vice versa in 2021. But two big drawbacks to this. One, it only includes the value of public companies. So, the U.S. Markets were actually declining in terms of the number of public companies for many years until the SPAC boom. So you have a lot of companies just being taken out of public trade, publicly traded market cap calculations. So that's one issue. It kind of works against the metric. And then the other one, which I think may be even more dominant and important, is that a lot of U.S. companies, especially the big mega cap tech stocks, they're global companies. So comparing their market cap to US GDP is a little bit misleading. Apple, Amazon, Google, Facebook, et cetera, they do a lot of business outside the US now. And frankly, actually, I think the top 20 companies in the S&P 500, for instance, still have quite a bit of global revenue. So using market cap of companies like that and dividing by just the US GDP, that denominator is not correct.
It's going to look more expensive, right? But I guess it is also open up to global risk, right? If China goes down the toilet, if the Eurozone has massive issues, right, it could kind of impact it even more.
That is a great point. Yeah, that's a very good point. So, I think, again, it's hard probably to use that as a market timing tool in the short run, but when it gets to extremes, I think when that metric would have something to say about whether stocks are undervalued or overvalued.
Interesting. Another thing that, Nikki, you pulled this up, it was the U.S. investor sentiment, both on the bullish and the bearish side. And if we look over the past 5 years, this is kind of a messy chart, but right now you can see things are kind of at an extreme where the bearish market sentiment is at basically multi-year highs on the kind of the channel here, and then the bullish sentiment is at multi-year lows. So things are definitely looking a little extreme. What do you guys make of that?
Yeah, I mean it makes sense. We've been seeing sentiment, like I say, in the trash can. Mm-hmm. The market hasn't done anything, and the macro picture hasn't really shifted that much to change anything, right? Like if we had a nice bounce in the market and inflation printed lower, that alone could maybe be enough. And, the Fed comes out with a 50 basis point hike, that could be what pivots us. But there's been nothing really to like pivot us. Mm-hmm. At least it's felt that way. It's just felt like we've been in this slogging along of we don't know. And the market hates unknowns. So it's no wonder that sentiment is so bad. But, I like to think contrarian, right? And I do think that there are risks, absolutely. But I still think we're in that scenario of there's good news and there's bad news. And how do you square that? How do you reconcile that and make investing decisions based off of that? And so it's really no surprise to me that sentiment is still bad. I think price will change sentiment. Mm-hmm. That's the saying, right? Nothing changed sentiment like price. And price is just boring and weak right now.
Yep. Very weak.
We did, like you mentioned, it's hard with looking at actual economic data, particularly in the U.S. specifically, because we had a good jobs report in the August jobs report that came out last Friday. 315,000 jobs again added in August, and unemployment rate
still low.
Yeah, still very low, 3.7%.
Yeah.
We had the U.S. ISM manufacturing and non-manufacturing reports still suggesting growth in both the manufacturing and the services side of the economy. Even if those numbers have maybe weakened a bit over the past 6 months, they actually surprised a little bit to the upside last month. So that's corporate earnings, like we said, last earnings season kind of held up pretty well.
Technically energy kind of held them up.
Sure. Yeah.
But still, considering.
Yeah. So yeah, when you look at the data for the U.S., it's just not that bad. We've got commodities coming down, so some of the inflationary pressure is starting to come off a bit. That could reverse, of course. We could see that reverse, but also there's positive upside scenarios out there with positive skew. Imagine the Russia-Ukraine war somehow gets closer to a resolution in the next 3 or 4 months. I don't know how likely that is, but what if that were to happen? I mean, we rip massively, right?
Yeah.
Inflation fears start to maybe reside in conjunction with that. Maybe the European doomsday scenario gets taken off the table with that. So that's one positive scenario I could see. Again, I don't know how high of a probability we should put on that right now, but
yeah, because it could go the other way, right? I mean,
Yeah.
It could get way worse, and food shortages could get even worse. And
man, I was listening to a podcast about that recently.
Mm-hmm.
What, food shortages?
Yeah, just the whole agricultural environment and food scarcity, and it's scary hearing about how the cost of growing food is just gonna really mess with people, and we're starting to see countries stop exports of their goods.
Yeah. Well, I know even here locally in Bali, it's like most restaurants you go to, you sit down and the first thing they say is, hey, by the way, we don't have X, Y, and Z that's on the menu right now.
Yeah.
Like there's definitely shortages here. I don't know if it's like that other places, but.
And it's funny because it kind of all stems from emerging markets starting to come out of emerging and into developing, right? And instead of just eating grains and rice, they're eating meat. Mm-hmm. And to make a bunch of meat for the whole globe to be able to eat meat, that requires a lot of grain. Mm-hmm. And the fertilizer for that is through the roof. And so it's like this, and the heat waves are screwing with this as well, and the droughts. Yeah. So, and the flooding. And so it's kind of scary to think about different countries like stopping exports. Like, what does that look like if they're kind of holding the food just for their country.
Yeah.
Is there going to be enough?
Or we're just going to be eating crickets, according to the New World
that
Order.
was on Shark Tank, right? That person came on, that entrepreneur came on selling the cricket
and
crackers.
The World Economic Forum they're pushing that narrative hard, man. Let's start eating bugs. I don't know.
I feel like I've probably been eating some bugs here in Bali. I feel like at nighttime there's been
not
a few.
intentionally.
I don't
Not
buy it.
intentionally, but
I think the market people want what they want, and the free market will
figure out a way.
We'll figure out a way to produce what people want.
So
over
you're
time.
not worried
Maybe
about
not in the short
that
run.
so
I'm not so
much.
worried about that.
Okay.
I think in the short run, yeah. I mean, like especially with natural gas being at very high levels in certain areas, that pushes up fertilizer prices. That becomes concerning. But it's also one of these things where in the media you have these cycles of negative news, and it's like once you go down the path of like negative news headlines, it just perpetuates itself. And so I've noticed like the headlines about energy and food and fertilizer prices like just spur more of those types of doomsday articles and headlines. And so I always try to pull myself back and say, where's the positive news? For instance, like here's a great example. Australia had a bumper wheat crop. So they had a ton of rain this season, bumper wheat crop. Actually, similar thing happened in Brazil.
What's a bumper wheat crop?
Like
mean?
basically a very good, above average production.
Is bumper like a agricultural term?
Yeah,
okay.
That's what they say.
Like,
we had a
like
bumper year, bumper crop. Yeah.
Nice.
So those things don't really get reported on very widely.
No.
But that helps, right? And
I didn't even know that.
yeah, exactly.
Yeah.
Because nobody's like writing
no
because
friggin'
like
idea.
you don't see that in headlines, or if you do, like it doesn't get widely circulated.
Positive news does not sell, Trav.
It really doesn't. It's such a problem for me.
Exactly.
Yeah.
Gosh. It's
All right.
very true.
You guys want to move on to some questions?
Let's do it.
All right. We've got a bunch of like personal finance questions and a couple crypto questions. The first one is Activist-ish asks,
I love that name.
right? Activist-ish asks, what investing advice do you have for people in their late 30s who want to invest for the first time? Am I too late?
Oh, God. Late 30s is still a baby.
Yeah.
Yeah, you still got decades of compounding to work for you. See, I come across this question all the time. You guys can chime in on this too, but a lot of people are worried that they're too late, and a lot of them are in their 30s, even like mid 30s. People are worried about that. And the fact of the matter is, if you have at least 10 years to be invested, it's going to help you. It may not help as much as it would have if you started when you were 20, but most people don't start when they're 20. Most people don't even start until they're in their mid 30s because they were never taught about investing or what investing is, and that they need to do it, right? So I would say most people are on that track where they're in their mid, late 30s, maybe even early 40s, and they're just starting to think about retirement.
What's that quote? The best time to plant a tree was 20 years ago. The next best time is right now.
Yes.
Like, yeah,
Exactly.
It's never too late. Obviously, the earlier the better, but get started now. Don't
Yes.
wait another second.
Some people have their best earnings years like in their 40s and 50s too, so that can obviously help like build a portfolio from the income side.
Yeah,
Totally.
The more you can maximize your monthly cash flow, the more you can feed that machine, the quicker it's going to grow.
Yeah, and in a scenario like that where you're earning more income, just focus on like maxing out, putting as much as you can. Maybe you didn't start when you were in your 20s, but if you're making money, lump some in as much as you can. I call it front loading, right? And just get it in there.
Awesome. All right, next question. What do you think of the ETH merge coming up? Is it bullish or bearish for Ethereum and crypto? Okay, here we go. So let me go ahead and pull this up. For anybody that doesn't know, Ethereum is going from proof of work to proof of stake in about a week. And there's a few different websites that are tracking some data. There's this one poll that people were voting for either proof of work versus proof of stake. It looks like about 80% or more of people want proof of stake. What does that mean? Well, you're getting rid of miners and you're basically saving the environment, right? Like instead of using
Don't say it like that.
I
You'll
know,
get-
right? I'm going to piss off some activists.
Yeah, you'll get upset. Activist-ish.
But anyway, we're getting rid of mining, going to proof of stake. You got to lock up 32 ETH to be a validator. We're not going to get in the weeds of what that means technically, but just know that it changes the dynamics a little bit. And there's risks, right? When we come down a little bit further here on CoinMarketCap, they're saying ETH merge risk, which chain would take over if like something happened. There's no consensus here. You know, everybody's got their favorite altcoin, their favorite network, their favorite ETH competitor, right? At the end of the day, the only narrative that matters right now is the macro narrative of what the stock market is doing. If you type in, like on YouTube, ETH merge, or like what's going to happen with ETH, you know, during the merge, you'll see a bunch of these, you know, shitcoin tubers that are like, I'm selling everything, it's over, and another 100,000x. You know, you're going to have people on both sides of the argument. This is a known event that's happening.
Event? Known.
Right. It's like a known event that's coming up. It's not a surprise event. What a surprise event would be, though, is if there's a major issue, similar to, you know, like Solana had some issues this year where the network just stopped functioning. If some shit like that goes down, yeah, it's going to be negative on the price of Ethereum during that moment of uncertainty and panic, right? So a lot of people are buying in anticipation of this being this massively bullish thing. I'm not so sure that we're just, as soon as this happens, that there's going to be a flood of buyers. I think it's priced in. I think we've seen relative strength in ETH above Bitcoin over the past couple of weeks. But as we're seeing today, if we just take a look, you know, with the NASDAQ selling off and Bitcoin testing multi-month support, let's just take a look at what ETH is doing. Well, it's still hovering above the 100-period moving average, but it's sold off along with the NASDAQ the past couple of days. So do I think this is going to be a catapult moment for ETH's price? No. ETH is going to follow Bitcoin, which is following the NASDAQ. It's going to be that way until we get evidence that something else is happening.
Could this be their version of like a stock split? Like it's a non-event, but like it could move. Like
I could see maybe a small short-term pop. I mean maybe because there is some fear that something goes wrong, and so if it does succeed, yeah, maybe it gets a nice little like small pop or something short term.
Yeah, here's what I'll say. I don't like. I look at this kind of like a major event in the stock market that's known, like Fed interest rate announcements, right? Perfect example. Mm-hmm. Like when I was day trading E-mini futures, I just wouldn't trade right in front of or right after a Fed announcement because it's uncertain. You're going to have algorithms throwing a shit ton of orders in. You just don't know how price is going to play out. It's the same thing with this, but it's probably a little bit of a larger time frame. I'm not going to trade ETH, call it 3 to 5 days ahead of the event, and maybe 3 to 5 days after the event, maybe longer if there's uncertainty or weird stuff that's happening behind the scenes, right? So I think just trying to predict what's going to happen on the event is a fool's errand because people buy in anticipation of it, people short in anticipation of it, and it creates a lot of volatility. So yeah, could there be a short-term price spike? Sure. But at the end of the day, Ethereum's going to follow Bitcoin, which is following the NASDAQ, and that's going to be true until we get evidence that it's not.
So in general, Ethereum is still supposed to function as it functions now.
Yes. Yeah, it's going to increase the transaction time a little bit.
Okay.
There's going to be next year more developments that are going to hopefully decrease the gas price for transactions, but right now this is just a kind of fundamental shift in how you secure the network. There's pros and cons to it. I'm kind of neutral. I don't really care. I'm a trader and investor, and you know, I think protecting against like 51% attacks is interesting by going to proof of stake, but I don't know. I don't think it's a huge deal, and I think people are trying to pretend that they're going to predict what happens to price based on it. And that's just not the case.
Feels like Y2K when we didn't know if the computers were going to be able to change over, right? The date.
That's a fun analogy.
We didn't know if it was going to go 2000 and like everything was going to crash and not work anymore. And it was like literally everything was fine.
Yeah, everyone woke up and was just like,
we're still here? Okay.
Yeah. I think this is a little more risky than that because it's like...
I'm just being stupid and funny.
It makes... I mean, it's a good analogy. It's probably the closest one, but...
I'm just trying to process, like, because obviously I'm a financial planner and a stock investor and trader. Like, I'm not as in with the crypto stuff.
Yeah.
And so I'm just trying to process in my own brain, okay, like, what is the impact here?
Yeah.
And
There
so-
were people that built like basements and had like food rations for Y2K.
Oh,
Like
yeah.
I remember that. I remember there being stories run on some of the big media channels about
It
how
was a
some
big
preppers
deal.
were preparing for Y2K.
Oh yeah, they sold a shit ton of magazines, and you know people love to lean into these fear-based stories, man.
Oh, so funny.
All right, let's move on. We got more questions here. Jay Rich was asking, should I put all of my retirement accounts together in one? I've had multiple employers.
This is one I get a lot. So basically, when you have an employer that offers you a 401k and you leave that employer, a lot of people end up with 401ks at their own employer, and they just kind of sit there and they're not continuing to contribute to it or anything. So a lot of people hate the idea of having, you know, a 401k here and a 401k there. And so what they do is they'll roll the 401k over into an IRA. And then basically they can roll, you know, different 401ks into that same IRA and have everything in one place.
Okay.
A lot of people like to do that just to keep things organized. And you don't have to do that if your employer is letting you keep your plan there and your employer has good, administration fees and good investment options, like the cost of the ETFs that you're in are affordable and things like that. But eventually, you know, it can make sense to just roll it over, get everything together and organized, and get it invested in low-cost index funds, or buy, you know, stocks if you want to do some stock picking.
Because 401ks are more limited than IRAs,
Yes,
right?
so-
Like usually they only give you a few options with a 401k.
Typically, it depends on the 401k provider, but yes, typically, like, you can only invest in maybe target date funds or certain types of ETFs, or even some people mutual funds only,
Oof.
which tend to have higher expenses associated with them. So it depends. That's why you have to find out all of this information and know the questions to ask, and then make the decision. Because some people just want to invest it their way, right? They want to, like a lot
They
of
want to
people,
buy GameStop.
They,
You know?
they want to have the funds to be able to. I know plenty of people that they can't buy individual stocks in their 401k, and so they want to, but they can't. So
So by doing an IRA,
by
that gives you more
rolling
flexibility.
rolling that old 401k into an IRA, you can have that flexibility with buying anything really that you want.
Cool. Next question. Ariana asks, are I bonds worth it? Trav, what do you think of I bonds?
My bonds are interesting. You can only purchase like a very small fixed
10K
amount. Not
per
very small, but
person.
yeah, 10K per person. And I guess
Why is that limit?
in a family you can get away with
You
more.
can buy
but-
for the kids,
Yeah.
and yeah.
Yeah, it's a limit because the interest rates are actually like pretty good on those, and they do reset, but basically they can keep up with inflation. And right now there's something like what 9%.
9.3
Yeah, so they've
for
got,
this 6-month period.
Yeah, so
So explain like I'm 5. Like, how do I bonds work? Is it directly correlated to the inflation rate in the U.S.?
yes, yeah. In fact, Nikki, you're probably the best one to speak on I bonds.
Yeah, so basically the government allows you to purchase I-bonds directly through them, and you can buy up to 10K per person in your family or whatever, or if you have a business, you can buy them for your business too. And the whole idea is that the interest rate adjusts for inflation. So it was all in the headlines recently when we got that big inflation print. What do we get? It was like 9%, right, or something like that. And headlines: buy I bonds, interest rate 9%. You know, all over the headlines. But what a lot of people don't realize is that the interest rate is adjusted every single 6 months for inflation. So as inflation comes down, you know, you're only getting that 9% until that 6 months is up, and then they readjust it. So if inflation is going down significantly, your interest rate is going down along with it. And so if inflation is going to stay elevated, or you expect inflation to stay elevated, I bonds make a lot of sense, especially for retirees on fixed incomes, right?
Yeah.
Like, why not lock in 9%? And then, sure, maybe it'll go down to 5% in the next year or two, and then maybe even lower. But hell, you had a pretty nice return for a little while. So that's kind of the idea.
It's very strange to me that it's a 10K limit. Like, I'm just thinking, like, a retiree who's
Well-
got a nest egg of a few million, what difference does a 10K investment really make?
The government doesn't want to pay the rate right now is 9.62%.
Of course. So is this
government
something they
doesn't-
kind of offer, like, just
They're
like,
throwing us
I
a
guess
bone.
we'll give you a little bit, like,
They're throwing us a bone, you know. They're like,
Yeah.
we'll help you out with inflation with only X amount, but
Yeah.
we
Well,
don't
guess
wanna...
what, folks? You can buy way more than 10K worth of Bitcoin.
I mean, I guess you could buy tips,
Yeah.
but those, I think this is a little bit better, but you just can't get as much.
Yeah, and I think, what's a little bit different here too versus tips is like tips will tend to reflect, depending on which series you buy, like can reflect, longer term inflation expectations through the interest rate. This actually gets you the ability to track like the inflation rate kind of in the near term.
Yeah.
And what's tips for people that don't know?
Treasury and inflation protected securities. So those are you can buy in almost infinite amounts as an individual, but basically those are publicly traded bonds that the Treasury issues that have inflation protection. So the interest rate adjusts based on the level of expected inflation. So those are also have a feature basically where you can kind of protect yourself against inflation. Now, tips in recent years, like they haven't really offered much yield above the inflation rate, so it's not like you're getting a real yield that's very high. But at least it helped you to keep pace with inflation if you invest in tips generally.
Yeah, I mean, I think a lot of people are looking for that type of hedge right now, right? When they're thinking crypto down, stocks down, inflation high, I need to protect myself against inflation. I mean, those types of things make sense.
Yeah,
Yeah,
they can.
I think that I like I bonds right now because I do think that inflation is going to stay elevated.
I mean, they're great. You just can't get more than 10K worth.
Well, I know, but for the average household, okay,
Sure,
for the
sure.
average household, husband, wife or spouse, whatever, and a couple of kids, and maybe you're a business owner, you could get some money in there, 40, 50K, but I know it's for some people that's not enough.
Right.
But for a lot of people, I mean,
It
it's
could help.
something.
Yeah.
And if inflation rates start coming down rapidly, you actually have a nice benefit there because you're locked in from the inflation rate for 6 months prior.
Right.
So that rate is resetting potentially a little bit slower than inflation's coming down if we're in a fast deceleration. So, in effect, you could be getting an interest rate for at least a few months that's higher than the rate of inflation, which is
I have a
nice.
question, Trav.
Yeah.
Prediction time.
Oh, all right.
Okay, let's rehash this. We talked about it a long time ago. Where do you think inflation will end up landing, like, when the dust settles?
Yeah. That's a
Long
great question.
run inflation.
I think like looking out on a 3 to 5 year basis, I still think we're gonna have we've had a structural change in post COVID in like the structure of the labor force, and a few other areas as well, like supply chains and things like that, where we could have, I think, potentially elevated 3 to 5% inflation versus the Fed's target of 2%. So I think that's reasonably likely. But
3 to 5.
Yeah.
Yeah. I mean, the 2% days are probably long behind us for a little bit, right?
I would imagine so, unless we get just a massive steep global recession that
True.
takes us
All the way back,
all the way back down and more,
which
in,
I guess
in a
is
rapid time.
possible.
Yeah.
Because we do nothing in America without extremes these days.
Right.
Everything's like either we're printing money and sending stimmies and going nuts, or we're doing nothing.
Yeah, or we went
or
from
we're going into a recession and the
Yeah.
Fed's just raising rates on us. It's like it's been extreme.
Yeah.
I think that's the case for like a whipsawing stock market for a while, right? Is like
The
kinda-
choppy. Yeah, that's what I've
choppy
been saying.
stagnation. Like, yeah. All right, next question. I don't qualify for a 401k at work. Is a Roth IRA a good second option to invest in?
Yes. The IRA is really going to be your only option. If your spouse has a retirement plan at work, you could maybe try to increase contributions into that, but basically, yeah, you'll have to go IRA. But Roth or traditional is the question based on your tax rate. And there's a bunch of traps you got to watch out for. If you make too much money with a Roth IRA, you can't even contribute to one. And if you have a spouse at work that has access to a 401k, there's just issues. There's traps there, so just be careful. Learn all of the rules.
Tax planning. It's boring
I
as
saw
hell.
I saw your eyes and I was like, I better shut
I know.
up.
And no. Listen,
I better stop
It's really
explaining
important.
this.
Yes. Do I start to nod off and fall asleep when we talk about taxes? Yes. But taxes are a lot of people's biggest expense, even more so than their primary residence. So it makes sense to do tax planning the right way.
Yeah, and people need to know these things. Like, do you know how many successful ass people that make a lot of money that have like contributed to Roth IRAs or traditional IRAs and it's completely like disqualified or not deductible? So many. I listen. I don't want to get into it too far, but I've heard a lot of stories of this. People have no idea.
So what do they do?
They have ineligible contributions that they owe a bunch of penalties and taxes on.
I mean, how do they fix it? Because obviously
you got
they
to
don't
pull
have
the money out, and then you got to pay the IRS money.
Oof.
It's
So
a
people are
mess.
incurring like tax liabilities that they don't even know about yet.
Yes, and that's why you have to know. Okay, if you're going to do a Roth, just know that there's a income limit, and
Yeah.
if you make too much money, it's an ineligible contribution to an IRA. So just these are things I try to teach people.
Right. So you've got a course, you've got training that you do that teaches this stuff.
Yeah,
All right. So
I'm a tax nerd.
yeah. So guys, reach out to Nikki. She's in the community. WeTalkMoney.com/community. You can check out our wealth building community and chat with her in our Discord channels about all that stuff. Yeah. So much fun.
I was chatting with a community member actually about moving a business offshore. Like they had heard about the idea of opening a business offshore, opening a bank account, and paying no tax and trading out of that. And like that's not going to work unless you like move your whole existence to that said tax haven country. A lot of people hear all of these things to do, but there are a lot of nuances and things you have to get around. It's not as simple as people think,
Yep. Well said. Well, look, just to recap, markets are down, but they're not dead.
There's still the chance of the higher low.
There we go. There's still that chance. Stop trying to dip buy stuff that's slow bleeding. Don't revenge trade. What does that mean? Yeah, you can take stabs at stuff, but cut them quickly if they don't work. Put on hedges. What else? Don't overtrade right now.
Build your shopping list.
Build your shopping list. Stay engaged. Like, don't be one of those idiots that rage quits at the bottom. I've seen this every damn market cycle since 2013. The people that are the loudest at the bottom and the people that are the ones that throw in the towel and publicly quit and make a stink are the ones that come back late in the bull cycle buying the top again. Now is the time to buckle down, build your shopping list, develop your skills, hone in, build capital from non-market sources. That way you're prepared when things rebound, right? That's how you make a shit ton of money.
Mm-hmm. Mm-hmm. Amen.
I was going to say buy the dip, but I was like, wait, no. I don't want to say that right now.
Buy the deep, nasty washout capitulation dips. Don't buy the slow bleeds.
And look, if you need help finding stocks, finding trade ideas, like that's why we do the community. We talkmoney.com/community, and come join us if you need help generating ideas. Like we're still working on new ideas. I added to a position this week. I think something could happen in the next 2 or 3 weeks there. So we're still taking trades.
Yep.
Yeah, and I mean, we've both been adding to the portfolio.
Yeah.
Even longer term stuff.
Absolutely. Yeah.
So it's not like there's nothing to do out there right now.
Yeah.
Yep. And I've definitely been buying some Bitcoin on the way down. I just have a lot of cash on the sidelines. I'm not going in heavy.
You should put it in I-bonds.
There we go. Yeah, I'll get my whole 10K worth.
I'm just kidding. I'm just trying to crack jokes today because I'm so damn tired.
Yeah, trading. You were up real late last night trading. Weren't
Yeah,
you?
forgive me today because I'm so exhausted I can't even think straight. So if I sound like a bubbling idiot, that's why. I was up till 2 a.m. This market time zone stuff is rough.
You'll get used to it.
I'm working on it.
Yeah. All right, guys. Thanks for being with us today. We're going to sleep. It's almost market open time. So, yeah, thanks for being here with us. Thanks to Y Charts for sponsoring the show. Again, go to wetalkmoney.com/community. Check out our wealth building community. Thanks to my lovely co-hosts. And hopefully you guys are enjoying the new studio here in Bali.
Heck yeah, I'm certainly enjoying it.
Awesome.
It is nice.
Yeah.
Yeah.
Got a great team here.
Yeah, the team's been great.
Yeah. Awesome. All right, guys. We'll catch you next week. Take care. Talk to you soon.